The banks didn't just shake the paper market. They tried to shake you out. Over the last day, spot price didn't just correct. It was violently tamped down. If you were watching the charts, you saw the carnage hit swiftly. A massive paper dump, a sudden price smash, news sites claiming the raid failed. And right in that second, fear worked. Your heart raced. Your conviction was tried. You didn't doubt the AG, you doubted your own mind. Your hesitation was exactly the goal. Because today the charts revealed the pure reality. Spot price snapped back to the mid-70s in one session, grabbing back nearly half the prior day's dump. That isn't how a broken asset acts. That is how a bear trap springs. Real crashes bleed out slow. Fake dumps reverse hard. We didn't see a fundamental failure, but a forced liquidation event built to transfer stack positions from shaking weak hands to the disciplined strong hands. The rigging mechanics are simple and ruthless. High leverage invites precision raids. Stop losses bunch at obvious lines. Algos know this, the banks know this, so spot is driven just deep enough to trigger panic dumping, just long enough to fool the herd. Once the paper selling is fully exhausted, the reversal starts rapid, totally unforgiving, and without a single warning sign. Here is the uncomfortable reality. If you sold out yesterday, you didn't exit risk, you absorbed it for a whale. Markets need sellers to move higher. They fabricate fear when sellers disappear, and once that fear does its job, it is discarded without remorse. That is why today feels shocking. Not because the rally is surprising, but because the story changed too quickly for your emotions to keep pace. If you are still stacking, understand this clearly. You weren't trapped, you passed the filter. Volatility is the cost of the ride. The sector doesn't reward faith, it rewards diamond hands. What went down yesterday was not an ending, it was a reset. And resets happen before the acceleration, not after exhaustion. This is where understanding matters more than guessing. Because if you can stay rational while the riggers weaponize emotion, you don't just survive, you position yourself ahead of what is coming next. If this analysis helped you stay focused, support the channel. Type 1. Inst the comments. If you held through the drop 2. If you stack the dip and subscribe, because the next phase of this move will be faster, louder, and far less forgiving for all. To understand why the bounce was so violent, you have to understand who panicked and who didn't. When silver dropped hard, the selling didn't come from long-term stackers. It came from speculators, the tourists, the traders who borrowed confidence instead of building it. These players trade with margin-tight stops and fragile psychology. When price moves against them, they don't reassess, they react. And that reaction is raw liquidity. That liquidity is exactly what the bullion banks wait for. Whales cannot enter quietly when spot is rising. They need sellers. And when sellers disappear near highs, the market must create them. That is why the tamp felt unnatural. It wasn't driven by new news. Mines didn't shut down. Industrial demand didn't vanish. Nothing fundamental changed. What changed was manipulation pressure. The manipulators shook the tree. As spot fell through, obvious support stops were triggered in waves. Each wave fed the next. Fear accelerated dumping, and dumping validated fear. This feedback loop is powerful, but it is temporary, because once the weak hands are gone, selling dries up. And when selling dries up, price doesn't drift higher, it snaps back. That sharp snap is what you saw today. The big banks didn't chase silver at 80, they waited. They let emotion do the work. Once contracts were dumped in panic, they stepped in aggressively absorbing supply without hesitation. That's why the recovery wasn't slow or cautious. It was decisive. When smart money commits, it doesn't test the water. It takes it all. This is why calling yesterday a crash is misleading. Crashes destroy structure. Yesterday didn't. Support didn't fail. It was briefly violated and immediately reclaimed. In market language, that's not weakness. That's confirmation. It proves demand is waiting underneath price, not chasing above it now. And this pattern matters because it repeats over and over. Every major bull run punishes late leverage and rewards early conviction. The pain isn't accidental, it is functional. It clears the path for the next move by removing those who cannot survive the shake. If you are still here, you're no longer guessing what kind of market this is. You're experiencing it. And experience is what separates participants from the professionals. Now, we need to talk about the machines because modern markets are no longer driven by human hesitation. They are driven by code, commodity trading advisors, momentum algorithms, trend-following systems. These are the dominant force in short-term price action. And once you understand how they operate, yesterday's chaos becomes quite disturbingly logical. These systems don't think, they react. They are programmed to sell when price breaks key levels and buy when momentum flips back in the other direction. Yesterday, when silver slipped below critical support, the machine switched from neutral to aggressive sell mode. Billions in futures were dumped automatically, not because the market was broken, but because the rules demanded it. This accelerated the fall, creating the illusion of total collapse. But algorithms have a major weakness. They cannot interpret context. They only recognize direction. So today, when price reclaimed lost ground and surged back above prior levels, those same systems were forced to reverse. Not gradually, instantly. They had to buy back everything they sold yesterday while simultaneously opening new long positions to follow the renewed momentum. This creates a double demand surge, short covering plus fresh longs, and the result is a vertical move that feels unreal if you're watching it live now. This is why V-shaped recoveries exist. Not because markets are kind, but because algorithms are trapped by their own logic. They chase price both ways, and when sentiment flips faster than positioning can adjust, the machines amplify the reversal just as violently as they amplified the crash perfectly. This is also why emotional traders consistently lose to systematic ones. The machines don't feel regret. They don't second guess. They simply execute. And when they're wrong, they correct by buying more, not less. That is the irony. The same systems that punish late buyers reward the early holders. If you understand this, volatility stops feeling random. It becomes predictable in behavior, even if not in timing. Sharp drops followed by sharper reversals are not signs of instability. They are signatures of algorithmic dominance in a very thin market. And right now, thin markets are exactly what we are dealing with here. Which brings us to the next layer of this move. Liquidity bonds and why silver does not move alone. Silver never moves in isolation, and anyone trading it as a standalone asset is already blind to half the picture. To understand why silver was allowed to run today, you have to look at what happened beneath the surface in the bond market, in liquidity, and in gold. Yesterday's sell-off wasn't born in silver. It was transmitted into it all. The bond market seized up. Yields spiked, collateral tightened, and liquidity vanished for a brief but violent window. When that happens, everything gets sold. Not because investors want out, but because they need cash. Gold was dragged down hard not due to weakness but due to forced liquidation. Silver, being the higher beta metal, took the hit even harder still. But here is the key: that kind of selling does not ever last. Overnight the pressure eased. Repo markets stabilized. Stress indicators cooled. Whether through direct action or quiet coordination, liquidity returned. And when gold stabilized, silver was given permission to move. Gold is the anchor. Silver is the accelerator. When the anchor holds, the accelerator slams hard. That is exactly what we saw today. Gold stopped bleeding. Silver exploded. This relationship is not theoretical, it's structural. Silver leads on the way up because it reflects both monetary fear and industrial demand. It crashes harder on the way down because it's thinner and more leveraged. But when the dust settles, it moves faster in the direction of the trend now. This is why today's recovery matters so much. It confirms that the liquidity shock was temporary, a flash storm, not a climate change. The broader system did not break. And because it didn't, silver snapped back to where it really belongs. If gold had continued lower, this would be a different conversation, but it didn't. It held. And that hold is the signal that the monetary floor remains fully intact. Understanding this correlation is your safety net. As long as gold remains supported, silver is not in danger. It is coiling. And coils don't resolve sideways forever ever. They resolve very violently. Now let's talk about something the paper charts can't hide: the physical market. While futures were collapsing yesterday and screens were flashing red, something very different was happening behind the scenes. Physical silver didn't panic. It didn't get cheaper. In many cases, it got more expensive. Dealer premiums didn't fall during the crash. They rose. and that tells you everything you need to know truly. If price were truly breaking, physical sellers would rush to unload inventory. They didn't. They pulled metal off the market. That means the paper price fell below the level required to convince real holders to sell. In other words, the futures market detached from reality briefly. And when that happens, it never lasts at all. Industrial buyers understand this better than anyone. They don't care about 5-minute candles. They care about securing supply. Reports from the dip show aggressive buying in the low 70s, not from speculators, but from entities that actually consume silver. They stepped in early, absorbed selling pressure, and created a solid wall beneath price. This is how real bottoms form, not with euphoria but with quiet absorption. The paper market pushed lower and found no follow-through. Sellers ran out, buyers didn't, and once that imbalance was exposed, the rebound became totally inevitable. This physical floor is what makes yesterday's move so important. It tells us that $74 isn't expensive, it's necessary. It's the price required to bring metal out of hiding. Below that level, supply vanishes. Above it, demand still exists. That's not a fragile setup. That is a massive squeeze waiting to happen. Technical damage from the crash looked dramatic, but it didn't last. The breakdown failed. Support was reclaimed. In market terms, a failed breakdown is a bullish signal. It proves the bears showed up and were overpowered. The trend didn't die, it simply hardened. As we move toward the final trading days of the year, this matters more than any headline. Because funds care about where price closes, not where it dipped. And right now, the structure is telling us something clear. The bulls are definitely still in control. This brings us to timing, because timing is where structure and incentive collide. We are approaching the final trading day of the year, and in Wall Street terms, this is not just another session. It is Judgment Day. Performance is measured at the close. Bonuses are calculated at the close. Careers are defended at the close. And that reality alters behavior. Funds that are long silver have one objective right now: finish the year strong. They want the chart to look clean. They want the breakout to look undeniable. And they are willing to spend money to make that happen. This practice is known as marking the close, and while it's perfectly legal, it is extremely powerful. Price is pushed not because of new information, but because strong incentives demand it. This is why today's rally is not random. It's the opening move of a year-end defense. After yesterday's flush, allowing silver to close weak would undermine the entire narrative. It would raise uncomfortable questions from clients. So the response is forceful. Futures are bought. Weakness is defended. The tape is guided much higher. What makes this moment rare is alignment. Market structure wants a higher close. Fundamentals want a higher price to unlock supply. Momentum systems have flipped back to buy. These forces don't always agree, but when they do, moves accelerate very fast. Short sellers understand this too. Anyone who pressed shorts into yesterday's breakdown is now trapped. Price reclaimed key levels too quickly. That speed matters. When a breakdown fails within 24 hours, it creates forced buying. Shorts must cover into strength, adding fuel to the fire. This turns dips into opportunities, not threats at all. But don't confuse strength with calm. Thin holiday liquidity means volatility remains elevated. Swings can still be sharp. The difference now is direction. The market has chosen it. The test wasn't about price, it was actually about resolve. And that test cleared the whole board. Now we shift from the immediate battle to the broader cycle because what just happened didn't weaken the trend, it prepared it. One of the most overlooked truths in markets is that strong trends require resets. Momentum cannot rise indefinitely without releasing pressure. Yesterday's drop did exactly that. It cooled indicators, flushed leverage, and reset positioning without damaging the long-term structure. This is where the January effect enters the picture. Fresh capital doesn't chase overheated charts. It looks for strength that has been tested. With silver, back in the mid-70s, the asset is no longer stretched, but it is still trending. That's the ideal entry zone for institutional money rotating in at the start of a brand new year. From a technical standpoint, conditions are now balanced. The market isn't overbought. It isn't broken. It's coiled. And coils are where trends are renewed. What looked like chaos was actually preparation pressure being released, so the move can continue without tearing itself apart entirely. Psychology confirms this. Fear peaked yesterday. Relief dominates today. But relief is deceptive. It tempts complacency. The market thrives on that transition, fear to relief to disbelief. Those who survive the fear are often shaken out by hesitation later. That's why understanding where we are in the emotional cycle truly matters. In true bull markets, dips are bought instinctively. That's exactly what we saw. The aggressive response to weakness wasn't accidental. It was learned behavior. Participants now expect higher prices and act accordingly. That shift doesn't happen in bear markets. It happens when a trend is healthy and strong. The move toward 80 didn't fail. It paused, and pauses after resets tend to resolve in the direction of the larger force. With leverage reduced and demand intact, the path forward is clearer than it was before the drop occurred. The market didn't break, it simply breathed. Now we look beyond charts and into flow because supply chains don't care about sentiment. As the calendar turns, the physical system tightens. Refineries slow output during year-end audits. Inventories are counted, not expanded. At the same time, industrial buyers prepare for a new budget cycle. This creates a dangerous imbalance, restricted flow meeting, rising demand. January isn't just psychological, it's structural. Corporations reopen capital expenditure budgets. Procurement departments move from conserving cash to securing materials. Silver isn't optional for them, it's an input. Solar, electronics, energy storage, none of it functions without silver. And when multiple buyers chase limited supply, price doesn't negotiate, it gaps up. This is why the floor established in the low 70s matters. It tells us that available supply is already spoken for. Any new demand has to bid above existing holders. That's how price discovery begins. Not with speculation, but with pure necessity. Globally, the pressure is even clearer. In several currencies, silver never pulled back. It continued printing highs. That creates arbitrage demand. Metal flows toward the highest bidder, and right now the global bid is rising. You cannot suppress a global asset in one market when it's breaking out in others everywhere. This is also where volatility becomes a tax. As price rises, swings widen. Moves become faster and less forgiving. This isn't instability, it's scarcity asserting itself. Thin supply combined with urgent demand doesn't produce smooth trends. It produces air pockets and sudden spikes. Understanding this keeps you disciplined. Noise increases near inflection points. Those who confuse noise with signal exit early. Those who recognize it for what it is stay positioned securely. The market isn't becoming riskier, it's becoming tighter now. As price advances, psychology becomes the final battlefield. Yesterday, fear dominated. Today, relief took its place. But the most dangerous emotion in markets isn't fear, it's comfort. Comfort makes investors stop paying attention to risk, while volatility quietly increases beneath the surface. And silver is entering a phase where emotional discipline matters even more than precision. This is where position sizing becomes strategy. If yesterday's move kept you awake, your exposure is too large. Not because the thesis is wrong, but because volatility is the toll required to stay in the trade. The path higher will not be smooth. $10 swings will become normal. Headlines will grow louder. Narratives will turn hostile again. This is not a flaw, it's confirmation. Strong trends shake participants repeatedly. They don't reward those who react. They reward those who endure. The goal is not to predict every swing, but to survive them without being forced out. That means anchoring your focus to what doesn't change at all. Your ounce count doesn't change, price does today. As silver rises, attention will follow. Media coverage will increase. Political scrutiny will intensify. Calls for regulation, taxation, or intervention will grow. These are late cycle symptoms, not early warnings. They arrive after the move is already underway fully. This is why patience remains the edge. The accumulation phase feels boring. The repricing phase feels violent. We are transitioning between the two, and that transition is truly uncomfortable by design. Those who can stay detached from the day-to-day noise, who understand why volatility expands as trends mature, will be positioned to benefit from what comes next effectively. Because what comes next isn't subtle at all. Now we step back and draw the final line because every market cycle leaves behind a lesson, and this one is unmistakable. What you witnessed was not chaos, it was conditioning. The market tested resolve before rewarding patience. It exposed leverage, punished emotion, and confirmed something far more important than the price target. The trend is intact, and conviction has real value. The strategy from here is not complexity, it is discipline. You do not need to outsmart every fluctuation. You need to survive them. As silver moves higher, volatility will increase, not decrease. That is the price of repricing an asset that has been suppressed for years.